Hello, my name is Bruce Griffin, the Executive Chair of Sheffield Resources. I'm going to share some slides with you to explain more about Sheffield Resources. Sheffield Resources is an ASX-listed mineral sands company, and the slides I've got to share with you this afternoon will cover a brief introduction to the company, a summary of our core asset, the Thunderbird Mineral Sands Project, talk a little bit about another project we have called the South Atlantic Project, and also talk a little bit about the mineral sands market. As I've already mentioned, Sheffield Resources is an ASX-listed mineral sands company. We're looking to build a portfolio of development and production assets in mineral sands. Our core asset is our 50% interest in the Thunderbird Mineral Sands Project, which I'll spend more time introducing. But at this stage, it's probably worth saying that's the world's largest zircon reserve. It's fully funded and actually around 80% complete as we're presenting today. Within the project, we have other growth options, including a stage 2 expansion, which again, I'll talk a little bit more about. We've recently added another opportunity, the South Atlantic project in Brazil, and we continue to look for other opportunities in mineral sands with the objective of building, as I say, a portfolio of development and production assets across mineral sands. I've already mentioned this, we are ASX listed. Market cap as it stands today is around 200 million Australian dollars. What I'd like to do before I talk about our projects, just provide some context, just explain what mineral sands is. It's not familiar to all investors. So mineral sands refers to a group of minerals typically are found in sand deposits, hence the name. The two primary minerals are a group of minerals containing titanium dioxide. We refer to them as titanium minerals. And then the other primary mineral you find is zircon. And just to explain what these are used for. So the primary market for titanium minerals is actually used in titanium dioxide pigments. And what the titanium dioxide pigments do is they basically are what makes a number of products non-transparent, or they're called opacifiers. So paint, plastics, and paper, that's what means that you, for example, can't see through paint, is because of the use of titanium dioxide. A lot of people are more familiar with titanium from its use in titanium metal, although that is a relatively small application, and by far the biggest use is in the oxide form. Zircon is the other primary mineral. Around half of zircon is used in ceramics, and actually the zircon in ceramics fills a similar role to titanium dioxide in paint. It's primarily an opacifier, and the way to think about it is if you look in a bathroom, for example, anything that's white and shiny will have a lot of zircon in it. And then there are chemical applications and some metals, and zircon also has some particularly interesting properties for use in refractory, so for making refractory bricks, for example, and in foundry applications. So both of these minerals are used in sort of everyday products, and demand is really driven by consumption-driven products. We have this is sort of summary of where we are in price cycle. We are near high prices for both of these products, and that's really driven by supply side effects. In the case of zircon, around about 55% of global supply comes from three main producers, all of whose main assets are either nearing the end of their mine life or actually very close to the end of the mine life, and so are struggling to maintain production and don't have obvious replacements for those mines. So what we're seeing is a sort of near-term and medium-term need for more supply, which is not being met, and that has resulted in sustained higher prices. We're currently seeing prices around $2,100 a tonne for zircon versus our long-term assumptions that all our economics are based on about two-thirds of that at about $1,700. On the ilmenite, which is our primary titanium dioxide product, there's also supply side effects here. not as extreme as in the zircon case. And again, prices are relatively high versus long-term price assumptions. If we talk about our assets now in that context, our primary asset or core asset, as we refer to, is the Thunderbird Mineral Sands project, and it's located in the far northwest of Western Australia. It is the world's largest zircon reserve. So this particular chart is showing the bubble sizes is the zircon and the ore reserve. The blues are producers and the greys are other projects. The size of the bubble is the reserve size, and then where the bubble is on the x-axis, or where it is in the horizontal, is about the zircon grade, and vertically is about titanium dioxide grade. And what you can see is that it's not only a large deposit, but it is relatively high grade for both zircon and titanium dioxide. What the reality is this, once in production, this will be one of the key sources of zircon for global supply for the next 2 or 3 decades, given its long life. I won't go into all of the processing detail, but effectively what the key takeaway is that what we're doing is producing concentrates in Western Australia, which means we do minimal processing on site. We basically mine and remove both oversized and undersized products, and then we use gravity separation. It's a spiral. It's basically just water mixed with the ore allows you to separate the valuable heavy minerals from the rest of the sand. And then we do a simple magnetic separation and a little bit more gravity separation to produce 3 concentrates, which contain our valuable products. The magnetic concentrate is predominantly the ilmenite product. The zircon concentrate contains zircon, and as well as some monazite, which is a rare earth mineral. And then we have a paramag concentrate, which is a smaller volume product, but does contain zircon, titanium dioxide, and monazite, the rare earth minerals as well. So one of the advantages of producing concentrates is it minimizes our capital investment, but also they're products that are sold, they're not sold against a hard quality specification, so it is easier to ramp up a project that is producing concentrates because you do not have to meet tight quality specifications. We have a partner in Thunderbird, as we own 50% of this project. We brought in a partner about actually 2 years ago. We formed a joint venture with a company we call Yan Steel, which is part of Tangshan Yangshan Iron and Steel, which is a private Chinese steel manufacturer. When I say private, owned by 3 individuals. They are building a complex, a pigment and smelter complex in China that is designed to produce titanium dioxide pigment and will consume the feedstock. Half of their feedstock will come from Thunderbird. So they've got offtake for our magnetic concentrate product, and they provided a significant amount of equity for the project as well. And their facility is already starting up, so we don't have startup risk associated with their project for when our project starts up later this year. The project stage 1, which is what we're building now, has we regard them as compelling economics. The NPV of the project is about $840 million. All of these are Australian dollars. We own 50%, so our share of that is about $420 million. The project, we're spending about $380 million on the actual capital. And then with all of the elements that you need to fund, like capitalized finance, etc., we're investing about $484 million on a 100% basis to build this initial project, which has a 33-year mine life. The chart shows the sensitivity of the NPV to some of the key variables. And what you see is one of the bigger driver is the commodity price. Effectively, the Australian dollar commodity price is one of the key drivers for any project. You've got, effectively US dollar market pricing combined with the Australian dollar exchange rate. We are, as I said before, this is over 75. I think as we speak today, about over 80% complete on the project. We made a final investment decision in Q4 last year. However, we had done a substantial amount of construction pre-FID, utilising the equity that our partner had brought. And so we've moved very rapidly from 45% complete at FID to over 80% today, which is Q2 of 2023. And we're looking to be in commissioning and starting up production in Q4 of 2023 and shipping the first shipments to customers in the first quarter of 2024. Just a picture paints 1,000 words when you're building something. For a construction site, this illustrates the scale of activities taking place at the process plant. These photos are from March of this year. So the one on the left is an aerial view showing a large area where we're doing the construction works, and then the one on the right-hand side is a tighter zoom in on the wet concentrator in the foreground. On the right-hand side, the thickeners being built in front, and behind is the concentrate upgrade plant. So considerable amount of progress has already been made, and we are on track for our startup late this year. Stage 2 of Thunderbird adds another significant amount of value. The idea we would be roughly doubling the mining capacity, would result in about a 50% increase in final products, and that's because part of the expansion would be to compensate for the grade decline. You start in the highest grade areas. We extend the mine life slightly. The capital cost is about 258 million was what we estimated when we started stage 1. And our share of the NPV, as I mentioned earlier, is about 275 million Australian dollars. The original BFS assumed that production we would do the project straight away with production early. We expect now that we can optimize the scope and timing of that expansion once we've started up stage 1. Just a couple of comments on ESG. For us, while we consider all the elements, and certainly from an environmental perspective, we're fully permitted for the project and have been for some time, and we have a focus in the governance of particularly having the right diversity at our board. Our primary focus for ESG is social. This relates to where we are. We're operating in a part of Australia with a high proportion of Aboriginal people in the community, and so we're aiming to have our workforce match our host community, and we're aiming to do that in operations, which is much more sustainable than in construction, which tends to be more boom and bust. So we're looking to develop long-lasting, potentially intergenerational job creation over a long mine life as a way of making a sustainable impact on the community in which we operate. In summary, for Thunderbird, as I've said, it is a 50-50 JV. There is a map there, probably at the end, which is showing where it is in the far north of Western Australia. We have offtake in place for about 80% of the revenue for the first 5 years. We've got people wanting to buy the balance. We've held that back at this stage. We'll place that product as we come into production. The project, as I've said, is fully funded. We're about 80% complete now. We do trade at a deep discount to value, even of stage 1 or stage 2, and we are on track for first production in Q1 of next year. We recently optioned another project called the South Atlantic Project, which is in southeast Brazil. The map shows sort of generally the location. The way to think about it is on the map of the deposits there, the southernmost of the deposits, Retiro, ends. That is a city. Either side of that harbour there is a city called Rio Grande, which is a major port in Brazil, a major soybean export port, and it is Panamax rated, so we can get bulk vessels to the end of the deposit. So basically we have a deposit here that runs 80 kilometres up the coast, starting in a deep water port. There are 4 deposits defined by licenses, but effectively it's one continuous series of mineralisation. We've defined exploration targets on the southernmost and northernmost resources, which combined have sort of 500 million, 720 million tonnes of heavy mineral, which, to put it in scale, this project is likely to be comparable in scale to about half of stage 1 of Thunderbird. So of that kind of order of project. It's a low slime, it's got no strip, so it's a relatively simple mining operation, and there's very good infrastructure. We're earning into this project. We're doing some work to better define the resource and also secure some of the licenses. And the intention is that the southern deposit should be licensed to commence construction, albeit that we won't be ready for that, but the permits will be in place for that by the middle of 2024. And at that stage, we should have earned our option to be able to acquire 20% of the project from the current owners. The primary owner is a very experienced family company in Brazil who's done many similar types of in other mining and other mineral commodities, but worked with international companies, brought them in as partners, and has actually stayed in and worked with them and exited once projects are in production. So we've got a good quality partner for this project as well. So in summary, as Sheffield, how we think about ourselves, first probably key point is we are fully funded through until cash is being generated from Thunderbird stage 1. We had 25 million in cash, Australian in cash, at the end of March, and that basically is enough to fund our option and the exercise of the option at South Atlantic should we choose to exercise that. So we've pre-funded that. We have a very lean corporate office, so we have sufficient funds to fund our corporate cost, and so total fund of about 25 million, as I said, fully covers those activities. Stage 1 is fully funded. The financing is in place for that. We do not need to contribute any more equity for that, and we expect by 2026 to be starting to see cash flow from the joint venture to shareholders and be self-funding from that point forward. I've sort of mentioned this before, and I'll make the point again. We do trade at a significant discount to NPV, and while it is not unusual for projects to trade at a discount to NPV, it is unusual to be 80% complete and less than a year out from first production and still be trading at less than half of the current of the NPV for what we're currently building, and that's not allowing anything for the growth from stage 2 and future growth from things like South Atlantic. The right-hand picture here is really illustrating that one of the advantages of long life mines in minerals is once you've built them, they have sustained high levels of cash flow for long periods of time. So we actually see the NPV of this project, if you do stage 1 and stage 2 combined, our forward NPV, which is the NPV at the end of every year, actually stays over $1 billion up until about 20 or 18 years into production. So there is a sustained period where the project not only generates cash, but has significant value left in front of it. So overall summary, and particularly in terms of our strategy and what are we trying to do, we are a mineral sands company. We are very focused on that. The idea is to focus on late stage development and production assets, the objective being to generate cash returns and growth. We'll do that primarily initially from our core asset, the stage 1 of Thunderbird, which we're building now. We then have growth options with stage 2 at Thunderbird, South Atlantic and Brazil, and we continue to look for other opportunities in mineral sands as we build that portfolio. And thank you for your time.